Hello, Business 630 students. This is Professor Hasse, and this is week 2 weekend update video. Today's date is Friday, November 4th, and I welcome you to the end of our second week of study, the capital valuation, time value of money, and debt valuation. Next week, we'll talk about stocks. This is all a preliminary, learning about capital and how we get it, how we manage it, and then also assessing risk and risk return. And speaking of risk and risk return, I have posted your case number 1, which is due in a week on Sunday, November 13th. It's an APA format paper. It's to take the company that you selected in your first discussion post, the company you all selected, and then do a risk analysis and interpretation. More about the details of this case study will be in my Monday video posted on November 7th. So if you have questions, you might want to hold off until you see that video. But again, also some of you can begin that study because it requires you to do some research, look up some things about the company, and also at the same time you can do some calculations if you have experience and remember how to do the capital asset pricing model and the weighted average cost of capital. But I'll talk more in detail about that on Monday. The question at hand this week is the time value of money and bonds, and that's the subject of our week 2 weekend update video or weekend video today. So let's take a look at that. One thing to note, if you go to your week 2 file folder under week 2 lecture notes, there's a file that we began on Monday of this past week. We're going to look at that file again today, and you can use that as a study guide and a review guide for this week's work. You know, we're talking about capital valuation and the time value of money this week, which all are parts of the overall theme of corporate finance, maximizing the value of the company to the investors, where you take assets that you invest in to produce revenue, to produce a profit, which produces cash flow. And that cash flow is used to grow the company, reinvest in the company, but also more importantly, pay back the investors who have lent you or have invested in you of your operations. Remember, another key trait of capital is short-term capital, sometimes called as working capital. We basically have 2 types of capital in finance. The working capital or short-term capital is current operating assets, inventory, receivable, cash, minus current operating liabilities, accounts payable, accruals, short-term debt. Your working capital position of your company is what you have available to run the day-to-day operations, where long-term capital is investments in physical plant, fixed assets that produces returns over the longer term. How a company manages their finance in short-term and long-term will maximize the value of their company. So we look at financial statements to give us an idea of what our profit is, what is adequate cash flow, what is our debt position, and we use that to go out and find capital. And naturally, one of the questions you're going to be looking at on your case number 1 in a risk analysis is being able to determine the company's capital structure. What is that mix of debt and equity that produces the asset that you can get a return on investment? The capital structure of a company is, for example, if I had assets of $100 and I had debt of $70, thus my equity would be $30. The capital structure of the company then would be 70% debt, 30% equity. You're going to find this for your company, your individual company, as one of the answers and data that you'll be finding in case number 1. What is the capital structure? Because that tells us where the money comes from, who we have to pay back as managers in return of the capital investment they gave us. Another example of tools to use in determining valuation is what we talked about a little bit on Monday is chapter 4, time value of money, present value. The present value of money today after looking at it going into the future, or the future value of money today, looking at it presently into what its value is going to be in the future. The key terms of time value of money are three: the principal, the amount of money you're talking about either being invested or invested; the interest rate that asset or that investment is earning or costing; and the time period involved. Is it 1 year, 10 years, 30 years? The time period of how long that investment is out for. That all equates to the time value of money. In regards to when you have money going out into the future, you have risk and return. How do we guarantee investors for us to pay back their capital investment with a high risk? High risk means high cost. And the reward to the investors, if they invest in you and you have high risk, is that they'll get more money back, higher interest rates. And so the key thing to determining risk and return in a company is what's their credit position? What's their credit position in the markets? And for you and I, when we want to know our credit position, we look at our FICO score. For corporations, it's looking at Standard & Poor's. It's looking at Moody's. It's looking at Fitch. These are the three main credit agencies to determine the creditness of companies. They determine a company's FICO score. But if the FICO score for companies is not a number, it's usually in an alphabet. You have an A rating, you have a B+ rating, you have a AA rating. Those indicates the credit worthiness of your business and thus determines the risk of the business. So one of the key things that we're looking at this week is how do we equate where we find capital, stocks, bonds, profits. Remember, there's three legal ways a company can acquire assets: borrow the money, get investor equity, and make a profit. What's the risk to the investors of giving that money and getting paid back? What's the risk to the company of going out and getting that money in the markets? That's what it's all about to determine the capital valuation of a company. First of all, I want to explain why I look like I'm in a dungeon in my picture here for this video for the end of week number 2. I am traveling this week and I'm on the road. I'm back in the Midwest. And so I'm in a dark and dingy hotel room doing this video on Friday night. So that's the nature of this. Apologize for not being at my office or back on campus, but I am traveling this week. And one of the joys or not so joys of online education is that we also can teach anywhere and you can learn anywhere. And that's what we're doing this week at the end of week number 2. Speaking of week number 2, I urge all of you, if you have not signed up for the professor meeting with me, the 5 to 10 minute just to get engaged meeting that I have asked in the first week. Our next meeting and last meeting is this Tuesday, November 7th. So if you have not signed up for the meeting yet, please do go to the discussion forum, pick a date and time. The only date now is Tuesday the 7th, and we will chat via Zoom on Tuesday evening. Remember, this is a graded grade. It means if you don't sign up and don't participate, you will get a 0. And this grade represents 5% of your course grade. So one of the ways that I see or find that you're engaged in this online course without you coming to a classroom is you attend the 1 or 2 sessions that I require during the course of the session. And one of those sessions is this week, November 7th. So if you have not signed up, please do so. Well, with our earlier video this week, we took a look at the time value of money in the case of discounting cash flow into the future. The net present value calculation of a future flow of money and comparing that future flow of cash inflow generated by that investment. In this case, the investment was $100,000. And as we found out, if we take the flow of 140,000 going out 10 years and discount it back at our interest rate of 6%, again, the principal is the annuity of the payments over 10 years, 140,000. The interest rate is what it cost us to get that $100,000, 6%. And the present value or the time is the 10 years, and we take that and discount it back to $96,000. So the $100,000 investment will not be paid back due to the amount of cash flow, 140,000, and the cost of that money. That's your discount rate, 6%. And we confirm that by looking at the internal rate of return, which is 5.33%. So our return is less than the cost. This is a perfect example of time value of money, present value analysis. We'll be doing a lot of this during the course of our class. That leads us to the next area of present value in regards to capital valuation, and that is bonds. In the lecture note spreadsheet, I have all 4 chapters that cover risk and return. And so let's go to chapter 5. We'll do chapters 7 next week, and I'm going to look at chapter 6 again in just a minute. But let's take a look at chapter 5 in regards to bonds. Bonds is a major form of financing for companies. Why? They can get lots of money. They can go out to the public markets, insurance companies, pension funds, a consortium of banks getting huge hundreds of millions of dollars to invest in assets. It's not an easy way, but it's a one-stop shop to get the money you need. Whereas some companies would rather deal with banks. But when you deal with banks, you're limited by the federal deposit laws and the federal government laws of how much money a bank can lend you due to their capital requirements. To avoid that, you issue bonds. Bonds are issued in lots of $1,000. So if I want to buy a bond in a company like Renfro Rentals, I can go to a broker, sometimes even to a bank, and with $1,000, I can buy 1 bond. Now, what does that $1,000 buying 1 bond get me? It gives me interest paid to me every year, and the principal, the $1,000, paid back to me at the end, at the maturity date of the bonds. So let's say we have a bond here from Renfro Renters, and I go ahead and purchase it for $1,000. It has a coupon rate of 10% with payable semi-annually. In other words, I'm going to get a check for $50 every 6 months during the life of this bond. How did I calculate that $50? I took 5% of $1,000. 5% semi-annually means 10% annual coupon rate. So when you think about it, this bond is due in 8 years. So I go ahead and I buy this bond. I lock in a return. I lock in 10% a year, $100 for 8 years. And then I get my money back. That's what makes bonds attractive to the investor, because you know exactly what you're getting. No questions asked. You know you're getting a check every 6 months for $50, and you're getting your money back in 8 years, guaranteed. If the company goes in default, you're at the top of the line. They have to sell assets. You still get your money. That's what makes bonds so attractive for the investor. It's a low risk, guaranteed investment. Now, what's unattractive for the investor? It's kind of boring. I can't make any more money than $100 a year. Where in the stock market, you have a big risk, but you can make a lot more money if the company is successful and performing well. At the same time, I'm only locked into a certain amount of money every year. So that's one of the downsides. Now, what are the positiveness for the company getting the money in the bond market? First of all, they now know that they have to meet these obligations over the next 8 years. $50 every 6 months, $100 a year, $1,000 at the end of 8 years. They lock that into their cash flow balance, cash flow budget, meaning they know exactly when they have to pay this debt off. And that's the attractiveness for companies. So they build this into their models when they go out and take that $1,000 that I just lend Renfro Rentals and invest it in an asset. Now they know that asset has to generate this kind of return over the next over the next few years in order for them to satisfy the requirements of the lending and also invest that investment wisely. So bonds are a pretty good way of judging a company's cash flow because you know exactly up front what's going on. Makes it very attractive. Now, what happens if I decide to sell this $1,000 bond before the maturity date? Okay. What happens if I decide to sell that? And that happens a lot. Now, the company doesn't have to pay me back. The company pays whoever holds the bond back in 8 years. It could be anybody. But for me, let's say I need the money fairly quickly. Well, let's say after 2 years. So after 2 years, I've gotten $200 in payments over the 2 years. Now I decide, I want to do something to my house and I need some cash. So I'm going to sell off this bond. So I call up my broker or I go online and I say, what is the current, I'd like to sell this $1,000 Renfro rental bond. What is the current yield to maturity of this bond? Oh, yield to maturity? Well, it's 8.5% annually. In other words, the interest rate or the yield of this bond has gone down in the market in those 2 years to 8.5%. Now, what causes it to go down? Credit worthiness of the company. If they would go out and issue a new bond today, that's the interest rate they would have to pay. They've gotten better credit. Maybe and probably the main reason for interest rates dropping is because the interest rates in the market have dropped. The overall interest rates in the market. The direct opposite of what's going on today in the world, where interest rates are going up, yields are increasing. If anybody knows what I mean by that. Yields are increasing in the bond markets today. Anybody know what the treasury yield of 10-year treasury, the risk-free interest rate is this morning or this week? Roughly around a little bit over 4%. 6 months ago, it was at 1%. So the yields are increasing. But in this example for Renfro rentals, yields have dropped to 8.5% or 4.25% semi-annually. So if I want to go into the bond market and sell this $1,000 bond, how much am I going to get for it? It's based on the yield to maturity and the present value of this $1,000 10% bond in a market of 8.5%. And there's a great way of calculating that using our formulas, function, our calculation of present value, PV, the interest rate now in the market is 8.5%. We have, it's an 8-year bond and I'm selling it after 2 years, so we have 6 years remaining. The payment on this bond or the coupon payment is $50 every 6 months. The future value of this bond is $1,000. Okay. And so we've put in the interest rate in the market, the coupon payment, the number of periods remaining. Oh, excuse me, that would be 12 periods remaining. I'm sorry, 12 periods. It's a 8-year, 2-period bond. So that's 16 periods. 2 years have gone by. That's 4. So 6 years remain, 2 payments a year. That's 12 periods, excuse me. So under that scenario, with an 8.5%, but again, remember it's 8.5% a year, so I'm going to have to put in the rate per period, 4.25%. There we go. So we have 4.25% per period, 12 periods, $50 payment coupon a period, $1,000 value at the end. So interest rates have gone down. What's the value of this bond in the marketplace? $1,069.38. Interest rates have gone down. Existing bond prices have gone up. Makes sense. In order for me to sell this bond in the market, I'm going to be making money. But for a buyer in the market who's buying this bond from me, they're going to have to pay more than $1,000. Why? Because they're buying a 10% bond in an 8.5% market. So the thing about that is that they have to pay more. This is called buying the bond or selling the bond at a premium, because they have to pay more to get the $50 payments. They would only need to pay $1,000 to get the $42.50 payments that exist today in the market. So they have to buy the bond at a premium. So interest rates going down make my bond more attractive, and I'm going to make an extra $69 by selling it today. That's called bond premium. Now let's say the direct opposite. Let's say the yield to maturity is 12%. Let's say this company's credit rating has gone south and the markets have gone north with interest. That means the interest rate or yield to maturity now is 12%, which means we have a 6% interest rate per period. What would our bond value be in that scenario? Same procedure, function, present value. Now the interest rate per period is 6%, not 4.25. The number of periods are still 12. The payment is still $50. And the future value is still $1,000. What is our bond value today in higher interest rates? As you can see, it goes down. Interest rates have gone above the coupon rate of my bond. Thus, my bond has a less value, $916.16. Why? So if somebody wants to buy my bond, they have to spend $916. In other words, I'm going to sell it at a loss, but they're getting a $1,000 bond, okay, at $50 payments, because their bond, they have to pay $1,000 to get 12%. Now they can pay $916 to get 10%. That is called selling the bond at a discount. Now, you're not going to have any problems where you're going to have to really calculate this. You just have to understand the concept, because that's a very important concept that's going on now, today in the market, in determining the risk and return for many companies. Interest rates go up, existing assets decrease in value. Whereas 5 years ago, 4 years ago, 3 years ago, 2 years ago, interest rates were going up in the market. Interest rates were going down in the market. Thus, existing assets increased in value. And that's where the time value of money and the present value come into form. Yes, you can calculate these amounts that we just did, but the main thing is the concept and the theory. In periods of expensive money, existing asset values depreciate. In periods of decreasing interest rates, existing assets increase in value. And that's very important for corporate finance management and strategic decisions, understanding what interest rates are doing, not only today, but where they're trending in the future. And that's why it's got people spooked in our economy today. Interest rates are going up. Inflation right now is nationally about 7%. The 10-year United States Treasury yield, which is the benchmark for all borrowing, is a little bit over 4%, where the inflation rate a year ago was 2%, 3%, where a year ago the 10-year United States Treasury yield or benchmark risk-free rate was about 1%. Interest rates have dramatically gone up. Thus, asset values of companies and their returns have gone down. And to make those assets turn a more profitable or more cash flow, they have to invest more or be more efficient in the management of those assets. That's why you're beginning to see companies lay off people, cut expenses, reducing the cost to increase the return of those assets that have depreciated in value with high interest rates, financing that's been attributed to those high interest rates. So that's what's happening in the real estate market. Interest rates are high. What's happening to real estate prices generally across the country? The demand is down, the prices are down. If interest rates were low, cheap, like they were for the last 5 years, housing markets were growing, and it made it more attractive to buy the assets because they were cheaper in accordance with the interest rates. So that's a key point of this week number 2 as we come to a close, is how the time value and the present value of money influence the value of A, debt and future value of that debt and the cost of that debt, and B, the discounted cash flow or the return. The higher the interest rate, the less return off an investment. And an interest rates going up, the risk is much greater to the management of companies. And you're going to be interpreting this risk in your individual company next week. And we'll talk more about that in our week 3 introduction video or lecture video on Monday, November 7th. So that's what I have to do or going over this week. What I would like you to do is take a look at your case, see what you can do of it. Make sure you understand what I mean by APA format is the paper side of it. Remember, we have a series of cases during the course of this session where you give presentations and interpretations of financial data, financial work in a different formats. This case is APA format, a written paper. And I'll explain more about that in my Monday video. One last thing, in a review of chapter 6 last week, remember we talked about the return on equity and the capital asset pricing model. The capital asset pricing model is a way of determining interest rates and the cost of equity in the market. And remember, we talked about, remember last week, the cost of equity is what it costs us to issue stock in relationship to the other influence of market indicators, the credit rating or the beta of a company, the risk-free interest rate, the expected market return. Those are all determining your cost of equity, your capital asset pricing model, the value or the expected return that investors expect to generate off the equity. This is one of the discussion points in your case number 1. So remember that from last week. So that'll give you enough to think about this weekend as we prepare. Again, the case number 1 is now posted. You can look at it, and I will talk more specifically about it on Monday. Everybody have a great weekend, and we'll talk to you soon. This is Professor Hasse signing off again. Adios.